Hey, everyone. Before we get into today's interview, just wanted to drop a little reminder to stay up to date with all the latest episodes of On the Margin. You can subscribe to the Blockworks Macro YouTube. Just go up there, just click the little subscribe button, or you can click the links at the top of this episode. It'll take you over to Apple, Spotify, whatever your preferred platform is. Just subscribe there. If you could, leave a rating and review. Really appreciate it. All right, on with the show. All right, everyone, welcome back to another episode of On the Margin. Today, I am joined by Clemente and Felix Jauvin from Reflexivity Research. Gentlemen, welcome to the program.
What's going on, Michael? Great to be here.
Hey, great to be here.
This will be a fun one, guys. I think of all the research shops that I sort of follow, you do a really good mix of blending what's going on in the macro and the crypto, and you seem to have a very good sort of bird's eye view of both kind of what's going on in macro at a high level, but then get very specific and I think very correct in terms of what's going on in the crypto space. So for folks, just to maybe outline what we're going to talk about here, we're going to start talking about a little bit more high level macro stuff and then drill down into some more specific crypto stuff. But Felix, maybe I can call on you here. I'm sort of pulling from your most recent report where you, I think, correctly predicted rate cuts when that was definitely not a consensus opinion and people were talking about higher for longer. So maybe just pull out this quote of yours, any more rate hikes at this point are nothing but a dream. In fact, rate cuts are extremely likely in the near future so that monetary policy can remain at the same level of restrictive, let alone to loosen or accommodate any sort of potential recession on the horizon. And actually, Janet Yellen said something very similar, just in terms of and kind of affirm that whole viewpoint. So, what made you get sort of the rate cuts? Obviously, we haven't actually gotten any of those yet in 2024, right? But just talk to us about your sort of thinking at that point and where you see rates heading into this coming year.
Yeah, totally. So, the basis of that discussion was really around real rates. And it's a bit more of a nebulous one because a lot of people have different ways of measuring what a real rate is, because a real rate is the nominal interest rate that you have in the economy, plus the either inflation expectations. Some people measure it with break-even rates. Some people even measure it with using CPI, which is a bit of an issue because that's a lagging indicator paired with a market-based indicator. So there's some issues there. But overall, big picture, what we've seen is that interest rates have been coming up over the last 12 months, as we all know, especially, the long end also caught up in the last 6 or so months. So now we have this yield curve that's quite elevated. And at the same time, we've seen inflation actually, peak out and start to come lower. And with that, expectations for inflation on like a 3 to 5 year basis have also been coming down. So as those inflation expectations come down, if we just hold the nominal rate at the same rate that it's actually already at, what that's creating is that the spread between the two is actually increasing. So that's actually increasing real interest rates. And as that occurs, even if the Federal Reserve decides to stay flat on the short end on the federal funds rate, that's actually creating marginal tightening without even hiking interest rates. So if we look at where, either core PCE or CPI or core CPI, where that's heading recently, one of the last lagging indicators of inflation has been shelter and owner's equivalent rent, and that's been decreasing significantly. So as that continues, and we get closer to that 2% range, what that's going to do is actually create further tightening if the Fed doesn't actually follow it downwards. So this is something that Fed President Williams actually mentioned a few months ago, where he mentioned that, hinted at this idea that just to stay at the same level of neutral tightness, they would have to actually cut rates to come lower. And this is something that Powell actually mentioned in his last press conference last week. One of the reporters, I forget which one, asked a question exactly about this. And he mentioned it's not exactly mechanical where they follow it perfectly down, but it is something that they follow very closely. And it is, leading to where they're attributing the Fed dot plots in the next year. The confusing part now is that we live in this live market era where we price in things and there's this whole forward guidance thing. So as that discussion has been occurring, what we've seen is that real rates have actually been coming lower because the medium to long end of the curve have actually started to price that in because yields have been decreasing. The only part of the curve that hasn't followed that obviously is the short end because that's fixed by the Fed and the federal funds rate. So if all else is equal and, we might shift around a little bit in that medium to long curve duration of the curve, if they don't follow down on that short end, it's actually going to continue to get tighter. So because of that reason, even if we're not saying that there's going to be marginal loosening of monetary policy in 2024, just to stay the same pace that we're at right now, they need to cut. So for me, just piecing that all together, and you can see exactly like you said, Yellen and Powell both had that inclination of mentioning that fact. It's pretty clear that we are at the peak here. Just to stay even at the same neutral level, we need to cut.
All right, everyone, we will be back to the program in just a moment. But before we do, I wanted to give you the inside scoop about something that we've been cooking up at Blockworks these last couple of months. So in March of this coming year, in London, Blockworks is going to be gathering 1,200 of the world's largest asset managers. So that's fund managers and allocators, financial institutions, think big banks, payment providers, etc., and professional traders at the largest institutionally focused conference in digital assets, DAS London. Now, it's very rare that you get the likes of JP Morgan, Goldman Sachs, Point72, the large HFTs, the family offices all in one room at the same time. So if you want to know what the big money is doing in digital assets these days, this is the conference for you. To give you an early sneak peek at some of the stuff that we're going to be talking about, one, the intersection of macro and digital assets, and where are we in the market cycle. We're going to be talking about real world assets, so that's stable coins, on-chain treasuries, all of that fun stuff. And we're going to be talking about things from the allocator perspective. So what are the big money managers in crypto doing these days? And because you are such a good listener of On the Margin, I'm giving you an extra code, MARGIN20. So click the link at the bottom of this episode. Again, use code MARGIN20, and I will see you in sunny London town in March. I'd be curious to get your perspective. You know, we've had Andy Constant on the program a lot recently, one of the old graybeards, and he sort of had this 5-act play. And one of the things that it was kind of his act 3, or one of the things that he was looking for, is basically for term premia to compress, for the yield curve to uninvert, and it looked like that was going to happen. And now a lot of the quote unquote progress that the Fed has made has been ultimately reversed. And, zooming out of even like the short term of the next, let's say 1 or 2 years, I understand the need for the Fed not to want to over tighten financial conditions. But how do you sort of weigh that against the sort of stop start inflation that we've seen, in the 70s or the 40s? Because obviously the risk here is we haven't done enough. There hasn't been a recession, and I can see inflation taking off here. Just look at what the stock market's doing. We're back to all-time highs. So what do you think about that risk?
Yeah. First off, I'm a huge fan of Andy, and his work in that 5-act play has been fantastic. And, he really nailed the last few months, especially with the QRA supply issues that were coming to light. So, all props to him. He's nailed a ton of stuff recently. I think that overall, this 5-act play has indeed, been pausing. We're almost back at that step 1 that he mentions. One of the big reasons for that occurring, and I think he mentioned this as well, is that they started to soften their supply issuance on the medium to long end of the yield curve, and that really reset expectations a bit. So back in November, I had a similar view where I put out this tweet saying that, if we get this softer QRA issuance, especially on the medium to long end of the yield curve, paired with a more dovish Fed on the margin, I could see equities testing all-time highs by the end of the year. And we're basically there now, like a month and a half later. So I think we are back to square one. And really the core of the issue here is whether you believe in the system that is perfectly efficient and fair, or whether I'm not saying that there's shady political games going on, but I do think there is certain incentive structures, around re-election, and different aspects like that could drive people to make irrational decisions. And I think Powell and the team would want everything possible to make them be somebody like a Volcker and not an Arthur Burns. But I think it's a more complicated world that we live in, and it can make us do irrational decisions. That's really the core of what game theory is to make decisions that are not perfectly rational, but seem rational when compared to these other circumstances. So I think that's going to lead us to having this more stop-start economy with these higher cyclical inflation cycles. I don't think inflation is dead by any means. And I think this is a clear reason this, paired with fiscal dominance, just continuing to get higher, is going to lead to these circumstances continuing into the future. So I think we are, in a way, somewhat lucky that we're just following inflation down, but obviously we know CPI is lagging. And I do think that's going to come to bite us in mid-2024. I do think we are back somewhat at square one, and we're a lot looser than what is being talked about by the Fed.
So I want to connect that with a subject that I know that you've spoken quite a bit about. So you mentioned fiscal dominance, and obviously the deficits. I've talked about it quite a bit on this program. I feel like it's getting some coverage, but probably not the amount that it ultimately deserves. I mean, I know, Felix, you have a lot of thoughts and have written pretty extensively about the U.S. fiscal situation, debt, and the long-term sustainability there. Can you just kind of walk us through what your overall framework is for looking at the U.S. fiscal situation? And then I ultimately want to come back and tie that to the inflation picture, and then we can get into crypto.
Totally, yeah. So essentially, there's a few fixed obligations that the Treasury have to support. Things like defense spending, things like Medicare, Medicaid, and these are obligations that have been somewhat set in stone. I don't think there's any congressperson that's going to get up there and say, "Hey, we need to decrease defense spending," especially in this world where we're seeing these geopolitical conflicts keep increasing rather than decreasing. So, what we have is this baseline of these certain obligations that the Treasury has to meet, and then on the side of that, there's this more variable expense, which is interest rate. Expenses on the debt of the Treasury. So this is something that, there's this chart that went around pretty often a few months ago of the Congressional Budget Office, just looking at deficits as a percentage of GDP. And I think it really shocked a lot of us. I remember I saw you tweet it as well, but, just the fact that by 2050, they see, deficits as a percentage of GDP being at negative 10% is quite shocking to come from a government institution to be suggesting that that's going to happen. So what we're
and they're usually on the low end, right?
Yeah,
that's what the surprising that consistently misses to the low end. So
yeah, so yeah, exactly. It's shocking. So we're in this world where interest expenses are going up, and they're going up mostly for the U.S. Treasury because they have to issue debt, and more than that, they have to be issuing debt on the shorter end of the curve because there's way less marginal buyers on the longer end of the curve. And this is the core of the issue of what was occurring in the last few months, where we saw these quarterly refunding announcements from the Treasury where they'd recommend where they're going to issue in terms of duration and amount on that curve. And consistently, they've been coming to the shorter end of the curve because they know that if they issue T-bills, they'll have that reverse repo, nest egg basically of sideline liquidity that they know that can buy it up. But that's, this is just short end, short-term thinking. Like that reverse repo is at 700 billion now. It's going to be gone and within a year pretty confidently. So that's a short-term fix. But the long-term fix is you have consistently increased debt that needs to be refinanced at now secularly higher interest rate levels. And somebody needs to buy it. And at the same time, we're seeing either, consistent marginal buyers step out of that market or become outright sellers. One of the consistent charts that I've seen is around foreign central banks and foreign sovereigns. There's been a bit of a confusing chart because a lot of those charts that show total U.S. Treasury holdings are showing it in a dollar value. And of course, the dollar value is going to come down because basically every bond in the world has been decreasing in price over the last couple of years because interest rates have been going higher. But even then, the fact is none of them are buying it. It's pretty confident. There's a lot of debate around whether they're selling, but we know they're not buying nearly as much anymore. So they're out of the game in terms of buying that debt. Hedge funds are pretty much maxed out. They have that carry trade going on where they basically buy the spot U.S. Treasury and then short the futures and basically make money on that carry. So they're pretty maxed out on that. Central banks are net not full on sellers, but quantitative tightening is occurring, so they're definitely not buying. U.S. retail has been buying up and making up a lot of that gap recently in terms of who's buying the debt. But again, that's also not necessarily sustainable, especially if we're moving into a world where interest rates are coming lower. Because as that occurs, there's going to be this rebalancing effect where, that 5% T-bill yield that I was getting is now 3%. And, I would rather go into equities now. So they could actually become net sellers of that short end debt. So overall, what we're getting into this big picture world is just asking ourselves, who's going to buy all this debt? And it really, when you go through the motions of analyzing these marginal buyers, you get to this point where you say, okay, there's either we need to have new laws or regulation to make, say, banks buy up more debt, tweaking things like the supplementary leverage ratio and stuff like that. Or we need the Fed to come in and start buying this debt and monetizing that debt, like what we saw in 2020, where they were directly, buying the debt, not necessarily just from the secondary market, but basically monetizing debt. So that was that world of monetary theory. So I think that's the end game that we're going at, is that somebody will need to eventually step in, because we have we have $700 billion in reverse repo buffer. And after that, things are going to get a lot more hairy.
One thing that I've started to wonder, because that is the ultimate question, right? And
Mm-hmm.
I've noticed that, I think, especially like Bitcoiners versus more traditional financial folks, they sort of whistle. What's that expression? Like you're whistling past each other in the night, ships passing in the night, whatever it is. And I think it's because people are talking on different timelines here. So, for instance, I just think there's not much risk, and this is where there's a little bit of a boy who cried wolf effect, because people have been talking about this since literally the end of the 1980s, probably even before that, when we started to run our first deficits, and it's been totally fine. And the reality is there's a lot of levers that the US can pull. I think people consistently underestimate the amount of levers that institutions like Treasury and Fed have to pull. They're extremely powerful levers, and they can probably keep getting us through for a while. But on a long enough time horizon, first of all, there's never been a long-term successful issuer of a reserve currency, and debt is always a part of the story when it comes to, however you want to, crumbling empires or whatever. But I've been starting to wonder if we're in the intermediate end game currently, because sometimes I like to put myself in the position of like, what if I had unilateral control of the government and I was just looking at the situation where the amount of debt that we're having is outpacing the amount of economic growth. That's the fundamental part of the math problem. And the only way that you can ultimately fix there is to do some sort of reset. This would be in corporate finance. This would be a restructuring. And how do you do that? Right? You find a way to lessen the restriction that you have on your debt, and the way that you do that is kind of growth. So you can either like cross your fingers and knock on wood and pray for productivity, which I think has actually been the strategy of policymakers for the last 10 or 15 years. I think that's what they've been secretly hoping for. But if all that fails, you can sort of inflate your way around it, inflate your way out of it. And we've been growing GDP. The nominal prints that we're producing on GDP are unheard of, at least in the US in the last 20 or so years. So I've been sort of starting to wonder if we're entering this end game where higher than normal growth, higher than normal inflation, maybe inflation settles around 3 or 4%. Maybe we start to get these sort of, think pieces about how 4% is actually much better than 2%. And, Paul Krugman comes out and writes some tweets or an essay about it or something. And then we all just kind of call it, hey, that's the new target. And we're actually all just okay with that. And I've just been wondering if we're in this sort of slow end game for a little while now.
Totally. And I think that's actually paired with why a lot of people have missed this whole recession play and thinking it was going to occur sooner than it has, is because they're missing just how strong that fiscal component of it. Because when we look at the core of what GDP is, it's consumer spending, it's investment, it's government spending, and it's net exports. And that G function, you can debate about how that actually gets recognized in terms of where basically the interest expenses from the Treasury are going to the holders of the U.S. debt. But the fact is, those people that own that U.S. debt, they're getting small stimmy checks every month or so, and they're getting that yield that is much higher than it has been in the last few years, and they can take that and they can go do some discretionary spending, and that is continuing, and it's this endless loop that is increasing. And so with that dynamic at play and this regime of more fiscal dominance, it's hard to see why there would be necessarily a major recession occurring. I think we're a lot more moving to this world of, you could call it financial repression. You could call it inflating the debt away. But for sure, I think we're moving to this world, and a lot of us have missed it, is that there's this fiscal dominance, and it's leading to people getting increased interest payments, and that is keeping the economy afloat despite higher rates in other parts of the economy. So totally, I think that's a lot more of the world that we're going in than the one that we're used to, where we just play these classic business cycles, and every 10 years we get a recession, and then debt comes lower, rates come lower, et cetera, et cetera. I think we're in this much more wonky world because there's so many more levers to play with, and it's a much finer dance that we have to play.
Yeah, I agree. Well, I'd love to get your thoughts here on how this ultimately ends up connecting with, say Bitcoin or crypto. And maybe to set the scene, we're recording this December 20th. So we are, I don't know, the way I've repeated a lot of times on this podcast before, so bear with me if this is like the fifth time you've heard this, but I feel like we're at this sort of unique moment in time where we've had a lot of headwinds turn into tailwinds over the course of the last 2 years. Like if you rewind the clock back to FTX, what was so devastating about that is like, not only did you have the FTX implosion, and you kind of knew regulators were going to come after you now, and it was going to be horrible for prices. But you also had macro going against you. You had, this was like peak sort of fear about rate hikes. I would say back at that time, and you also sort of had like this. Everyone knows sort of this 4-year cycle. They had that as sort of their mental framework, and they're like, man, it's going to be years before we're even close to a halving. But now, we're kind of looking at this, potentially very good macro backdrop. Rates are moving in the right direction for us, and we're a couple, weeks or months out from a potential spot ETF, which was not necessarily on my bingo card, and then halving. So walk us through. Will like help translate some of the macro that we talked about to your sort of current position on crypto.
Yeah, I think to kind of piggyback on what Felix said, what a lot of people I think kind of misinterpreted about how Bitcoin behaves in terms of its role as kind of a macro asset is Bitcoin's not a CPI inflation hedge. Bitcoin is a monetary debasement hedge. And this is something that even myself, I made this mistake in kind of back half of 2020 into 2021 thinking, and, kind of with the benefit of hindsight, towards the back half of 2021, as CPI inflation ran up, I think a lot of people became confused once Bitcoin started to roll over kind of the end of November into December of 21. But, kind of seeing it through the lens of being a monetary debasement hedge, it makes total sense, right? Because kind of the asymmetry of where you should be expecting liquidity to go from there was towards the downside, given the Fed was probably going to tighten monetary policy to combat inflation. And so I think now you've kind of got the inverse of that. So you've got inflation coming down now. And so it's okay, well, what's kind of the asymmetric profile of liquidity from here? It's very much skewed to the upside from here. And I think, on the back end of that, so should kind of your expectations for Bitcoin. And yeah, I think, there's a couple catalysts over the next 6 to 12 months that are incredibly positive for Bitcoin. I don't really have an edge in kind of predicting, the short-term price, at least at the moment. And I'm not doing so. I basically have the highest conviction in kind of where Bitcoin trades maybe over the mid to long term. And I've got my portfolio constructed accordingly. We've got the ETF coming up on the horizon. I have no idea if it's, buy the rumor, sell the news, buy the rumor, buy the rumor, buy the rumor. Who the hell knows? I have no idea. You just got to, look at the price action and kind of derivatives positioning going into that. I will say, we've seen a ton of CME open interest, which is most likely, like kind of TradFi, hedge funds, maybe high net worths that are putting on the ETF trade. And that OI probably has to kind of get unwound around and probably will around the ETF. So maybe we see some kind of chop, between the time of the approval and the listing itself. But, I think when you kind of zoom out, this is probably the biggest point for Bitcoin in its history. Kind of the legitimacy and, like decreasing career risk that's brought on by that stamp of legitimacy of an ETF, the potential unlocking of passive flows, and then not to mention kind of the mass marketing blitz from all these massive financial institutions that are going to try to get people to basically buy into this fee generation machine for them. I think all of those things shouldn't really be, underestimated. The halving in itself, does the halving actually have a material effect on the actual supply demand function of Bitcoin? I kind of lean in the camp of not really, but I think it's a great meme. And, and look, like after this halving, I think like the big talking point for Bitcoiners is, I know a lot of people aren't too fond of the stock to flow pricing model, but just the stock to flow ratio of Bitcoin will be greater than that of gold after this halving. So I think that's a great meme, while you have this backdrop of net liquidity conditions increasing throughout that time period. And then also, I think the other thing that not many people have talked about, and I think people have talked about the fact that it's an election year, but the likelihood of us seeing either Trump or Vivek or one of these, more conservative candidates probably getting into office in the back half of last year. I think that would be a really especially Trump would be a very positive thing for the market as well in terms of, if he were to step in, he probably comes in and just tells Powell to cut rates. So yeah, I think there's a ton of positive kind of catalysts on the horizon for Bitcoin. And, I'm just sitting comfy in spot for the next kind of 12 to 18 months.
What's going on, everybody? Thank you for listening to On the Margin. I just wanted to take a quick moment to let you know about a very special offer that we have coming out of Blockworks Research. Now, many of you will probably be familiar with our platform, but Blockworks Research is the most blue chip spot to get research, data, governance, models, and a whole lot more about the leading DeFi protocols in the space. I've leaned on our analysts time and time again to explain complicated concepts going on in DeFi to me like I'm 5 years old. They can do the same for you. If you invest in DeFi or are just interested in it, it is an absolute no-brainer. As a listener of On the Margin, and to say thank you all for listening to the show, you can use Margin 10 for a 10% discount, and that gives you access to everything, which would be weekly in-depth reports, live data, all of that good stuff. So again, that's code Margin 10 for a 10% discount. Link is in the show notes. Sign up now. Thank you later. One of the questions that I get asked a lot is, first of all, retail, I don't think is back to this market yet. And doesn't even feel like they're particularly close. But, one of the things that it comes up in conversations with friends is like, we're never going to see another market like 2021 again. That was a once in a lifetime thing. The Fed pumped $7.5 trillion worth of liquidity into the market. You saw all this crazy stuff. And if there is another cycle, it's going to be much more muted. I sort of have an internal opinion on that. I think you could point to what's going on already with meme coins and a certain dog with a little hat. And I mean, it's been actually remarkable how quickly the willingness to gamble on things like meme coins has sort of come back. And I'm not sure if there's anything to read there in terms of how this cycle is going to play out. But what is your sort of mental model for like this cycle? Do you subscribe to the idea of like generally diminishing returns across from one cycle to another? Like, help listeners who might not have as much of a solid framework think about, if we are in a bull market, what it's going to look like.
Yeah, I could maybe just add a couple points and then let Will jump in after. But first off, I think the question there is, will we ever see QE again? And there's a lot of people that disagree with that aspect. I believe that we will for sure see QE again. Just as we discussed at the beginning of this show, there's a lot of debt that needs to be monetized, and they're the last person that's really available to do so. So I do think it will occur again. I don't know if it'll occur under the same moniker. We might have a new acronym coming out for how they decide to do that. But at the same time, it might be not done as quickly. But I do think it will happen again. And I don't think that was the last cycle. And in the same vein, I think what we're seeing is that this gambling part of society is increasing. I just recently got cable again and have started to be watching a lot more sports and hockey, and every commercial, like it's a sports betting commercial. It's everywhere. So I think at the core of it is the same reflection that's happening in crypto with people gambling on meme coins. And really what it is that we're seeing a world where wealth inequality is significantly increasing. The cost of living is significantly increasing. Real wages have been flat for 30 years. So it's sort of like a last gamble. And it's this symptom of the sickness of society somewhat, that we need to gamble our way out of the lower middle class. So I think that is going to actually increase. Maybe not even if we see an increase in monetary liquidity. I think that's just a symptom of society. And Will, feel free to add in.
Yeah, I completely agree. And the wealth inequality is a byproduct of 15 years of monetary debasement via QE and just the dollar depreciating over time, right? Let alone if they're backstopping things just over time. The people that hold assets are continually benefiting by the amount of monetary units in the system increasing. And so, creates wealth inequality. But the other thing is, if you see that translate to, over time, actual price inflation on things that people are buying in their everyday lives, you basically create this incentive for people to want to like hyper speculate on everything. If you go back and read the book, When Money Dies, I read it like 2 years ago. It's basically about kind of all the activity that took place around, Weimar Germany. And I'm not saying that the U.S. is going to go into hyperinflation, but on the very extreme end of this, what you saw during that time period was asset prices mooned because the denominator is increasing, but also just the amount of speculative activity in markets just went through the roof. And so, one thing I think a lot of people know that I started off very much kind of Bitcoin only, strictly focused on that, didn't even look at anything else. The thing that kind of opened my mind to shifting into looking at other things is, on the same coin of you should expect Bitcoin's price to appreciate because monetary debasement is programmed because they have to print more money to service the debt the United States does. On that same note, not only should you see money flock to hard assets, and I believe that that'll be mostly Bitcoin, and Bitcoin will devour that entire pie, will become the biggest monetary premium beneficiary of any asset. On that same note, if you believe that there's going to be a ton of monetary debasement, you should also, on that same note, believe that there's going to be a ton of speculation. And this is kind of the whole thesis of, the hyper financialization of everything, right? And I think crypto is kind of the cleanest recipient of all that activity. A lot of people say crypto is strictly speculative and it's inherently speculative. I think that's true. And I don't think that's necessarily a horrible thing. But I think the same kind of argument, and maybe a lot of the maxi crowd would push back and say, well, Bitcoin is kind of the surest thing. I don't want to participate in that type of stuff. That's fine. But I think, when you kind of lay it out on the same coin of believing that Bitcoin should appreciate in price because of monetary debasement, you should also acknowledge that there's probably going to be a massive influx in kind of speculative activity around that. And again, I think the largest beneficiary of that is crypto, in addition to kind of broader gambling, that might also be brought into kind of crypto native applications as well.
One thing I'd be very curious to get your thoughts on is what's going on with Ethereum right now. So Ethereum had, a vision that was very different. And I actually think you could see it as sort of a counter reaction to Bitcoin, which is Bitcoin. There was this conflict fought back in 2017 called the block size wars, the big versus the small blockers, with very different sort of visions for where the Bitcoin project could go. The small blockers won, and ultimately what we wound up with was what I would argue is kind of an app chain for money, right? There's not a whole lot of utility, but the utility is just that it's extremely safe and secure block space, extremely decentralized, and therefore, resistant to maybe like censorship or a nation state sort of attack. And it was kind of hyper optimized for this one use case. And Ethereum said, well, hold on a second, maybe if we had a little bit more flexibility here, slightly larger blocks, smaller block times, and a more general smart contracting language, we could build a lot of things here. And instead of the value being derived from this very specific property of its block space, we can actually build real applications on it. And so Ethereum kind of has gone through this evolution as being a smart contract platform to ETH as ultrasound money. And I would be very curious to get a sense from you guys about whether or not you view Ethereum also as some sort of commodity-like money, something like that. And also, it's obviously underperformed this year quite a bit. So I don't know if you have any more specific thoughts on that.
Felix, I see you smile. So I'll let you take
it. Yeah, just the ultrasound money meme got me smiling there. Yeah, I mean, I think to circle back to that question, I'll just start with summing up my view of Bitcoin through a macro lens. And for me, it's this idea of this decentralized, pristine collateral is a word that really got thrown around the last few years. But for me, it's this neutral reserve asset or collateral piece that can be traded either between major institutions in the world that can hold its value against fiat debasement. And I think it's a really powerful idea, and it really stands on its own from everything aside that we're talking about. So for me, that sits there as this idea of really solving and being a life raft to a lot of the issues we talked about in the first half of this show. And the other side of things, I see this new paradigm of financial and technological innovation occurring that has less of a need to fulfill those needs of outright full-on decentralization and reserve currency. So for me, this idea of ETH trying to go after this ultrasound money idea and basically competing with Bitcoin, I think is totally wrong. And it should focus on a lot more of what's, a protocol like Solana is trying to do, which is to become that instant settlement, high throughput layer for the new financial system, where we see instant settlement of real world assets or something like that on there. So I think it's leaving ETH in this weird spot where we're seeing a lot of activity move towards Solana right now, because they really focused on speed and then decentralize after, versus ETH. It was a lot more about decentralize first and then scale afterwards. And somewhere in there, basically retrofit the ultrasound money idea onto it. So for me, I see those two worlds living complementary. I think we have Bitcoin as its own thing, and then we have this new financial digital system being developed that can live on its own as well. So I think that's leaving ETH in this weird spot right now, because there's part of that community that's been focused on trying to basically compete with Bitcoin, and then there's the other half of the community that's trying to compete with these new high throughput L1s. So it's leaving it in this weird spot, which is what we're seeing right now.
So obviously Solana, I feel like, has been the comeback story of certainly this year. And yeah, to sum it up, I think they took a, I've heard Anatoly discuss this. So he was an engineer at Qualcomm, and when he was writing software, one of the things that you're doing when you're writing software is trying to anticipate the growth of hardware. And so he was always trying to write software, and that with the assumption that hardware was going to grow, so he didn't have to rewrite his code sort of year over year. And that is exactly, I think, the thesis that Solana had, which is we care about decentralization, but we're going to ultimately allow our, basically design our current requirements on the idea that eventually hardware is going to get more efficient and it's going to become cheaper and more decentralized over time. In addition to a strong repricing, I think one of the most violent, sudden narrative shifts that I've ever seen in between, like kind of away from Ethereum and towards Solana. So, do you expect that to continue going into this coming year? Is it more of a flash in the pan from your standpoint, and there's going to be some sort of mean reversion back to Ethereum? I mean, how do you kind of interpret this rotation, whether or not it's here to stay?
Yeah, I can take this. Yeah, I think like what's taken place over the last couple of months has really kind of opened up the discussion in the smart contract landscape of, very much just the first principles ground up view of, okay, like, what are we optimizing for here? I think interestingly, this kind of sets up a pretty good condition for some of these kind of higher throughput EVM based chains to do well. So we've seen Say run pretty aggressively over the last kind of 2 weeks. And I know Monad is launching sometime mid next year. These types of things are pretty interesting because you kind of take the best of both worlds from, kind of the high throughput side on what's really been driving the price action for Solana. Whereas, still maintaining EVM compatibility. So, a lot of these, contracts can pretty seamlessly plug in. So that's kind of one area of the market. And, Michael, I don't know if you want to get into this tweet I had about a couple of my theses. I can show my bags. But this is one of the this is one of the theses that I think will probably do well throughout the year. Is these kind of smart contract platforms that sit at kind of the intersection of both Solana and Ethereum. I just think from kind of a mind share and narrative standpoint, it makes a ton of sense.
So Blockworks recently did an analyst call, and I feel like that is despite it having sort of already played out, I feel like that is the big narrative to understand in this coming year. And, even for me, I feel like most people who aren't super on-chain native spend all of their time, LPing or trading even during bear markets. Like, I feel like many people had a very similar experience, which is like, okay, prices are starting to go back up. I'm going to buy some stuff that you can only get on chain, and I'm going to do some of that on Ethereum, some of it on Solana. And there's been this kind of like light bulb moment where you go back on Ethereum and it feels like, all right, everything costs $60. I've got a bridge to these layer twos. Man, it's been a while since I've done this. This just feels shitty. But on Solana, everything just works and it's instant. And we've been waiting. There's a lot of debate, internally within crypto about fees and whether or not fees are a good thing. Again, I think people talk past each other on this specific issue, but definitely I think now that there's a functioning, legitimate community that has extremely low fees and very short block times, it just feels much better to operate over there. And people have been wondering when UX is ultimately going to be a big determinant. And I feel like this is probably the cycle. And if you aren't innovating on that, then that's going to be really tough. Now for layer twos, they have the ability to do that, right? Like Monad is leading the charge on re-architecting the EVM. I know the Ethereum Foundation is super interested in that. And I think that's the sort of opportunity set for the Arbitrums and Optimisms layer twos of the world. But I agree with you, Will. I feel like that is the trend to understand going into this year, actually. And I would expect to see that continue.
Yeah, I completely agree. I think also there's a decent chance that, dare I say, as people have been trying to like take a stab at this, and I don't have a trade on for this, but that there might be a rotation from BTC into ETH after the Bitcoin ETF gets approved, as people maybe shift focus towards a potential ETH ETF. And so I think it makes it even more interesting if you have Sol that's ran really aggressively throughout the year. It's up, whatever, 7-8x off the lows. And then, if you do have kind of a mini 1 to 2 month run for ETH, potentially around some type of ETH ETF front running, then it really opens up that discussion even further. And I think there's a pretty clean, kind of wide open setup for someone to kind of step in and say, hey, look, we kind of provide the best of both worlds. So I think, the L1 landscape's probably the most open for competition that it's probably ever been.
Yeah. Well, I want to ask you about some of these other maybe like public markets plays. So we could talk a little bit about Coinbase and miners. So Coinbase, I was going to say quietly, but certainly very, very loudly has outperformed over the course of the last year. There was a point in the last 18 months, I'm not 100% sure when, around FTX, when I think Coinbase was trading at sub $35. Today it's around 150. And it feels just like, knowing a little bit about Coinbase, and I read the earnings reports just for fun. They've trimmed their headcount, they've reined losses in. I feel like it's not quite priced in yet, but crypto has done extremely well this past quarter. I feel like that was the bottom in transaction volumes, but now they have all of these other really interesting revenue streams as well, be it what they're doing on Base or the partnership that they have with Circle with interest income. I mean, what's your sort of thought on maybe Coinbase going into this next year?
I think when you look at Coinbase and the public miners, they both kind of have this over-encompassing kind of theme that I think is really interesting in terms of allocating to them as a crypto native. I think with both of them, you have kind of this informational edge as a crypto native, and we can get into both. But to start with Coinbase, I think the street fundamentally views them as just a traditional exchange, and all their revenue comes from fees on the exchange. Meanwhile, I think Coinbase has built out several verticals over the last year, from everything from staking as a service, their Base L2, wallet as a service. They have the offshore derivatives exchange. They just announced that they're going to prioritize pushing spot trading outside of the US. Also the Circle acquisition, which was brilliant, right? Because it basically hedged the monetary conditions in which their business does well. So, in periods of, when interest rates are low, their business typically does well. When interest rates are higher, then Circle's business is doing well because they basically just, issue the stable coin, back it with treasuries, and pocket the yield. And so I don't know exactly the percentage of Circle's business that Coinbase owns, but I think that was a pretty brilliant acquisition as well. And then, they have the SSA agreements with all the ETFs, or the custodian for the ETFs. There's a couple different verticals of the business that I think they've established over the last year that the street maybe doesn't fundamentally understand, or really is giving a ton of weight to. And so I think as a crypto native, you have kind of a almost informational arbitrage play to say, hey, look, we understand how these kind of crypto native verticals may benefit the business, especially in kind of a raging crypto bull market, whereas the street doesn't. And that's kind of where your maybe edges, or where you're kind of expecting that repricing to take place. And then same, broadly with kind of the, cyclical nature of crypto. I think you can make an argument that kind of having the knowledge of this kind of crypto native cycle that maybe isn't getting priced in by these kind of trad firms into some of these public crypto equities. And then on the miner side, I think where you kind of have an informational edge as a crypto native is in basically having real-time data, right? And I know you guys launched the data product. And this was kind of, I'm guessing the whole thesis of launching the data product is in nutritional finance, you don't know a company's earnings until the end of every quarter. Whereas with miners, we can literally look at, I can tell you right now, the amount of fees that were, printed by the Bitcoin network, what percentage of that came from the block subsidy, and what percentage of that came from fees. And so, we can see in real time, over the last, call it month or so, we had this initial kind of run up in Ordinals activity at the end of March, early April of this year. A lot of people said that was just a flash in the pan. We've seen that start to run back up. I think very rarely do you want to kind of fade the second bubble of something. So we'll see if they have staking power. But, I think if they do, the street's not pricing in, I think, higher Bitcoin prices, but then also, kind of sustained activity for ordinals. If you go and look at fees, I mean, we're sitting at, $500K to $750K, kind of on average, roughly throughout Q3. I mean, fees on Saturday were $23.6 million. I mean, that's insane. It's like a 40x increase in fees. Like that, if that sustains, it's absolutely not priced in. So look, I think, if you're bullish on ordinals, you probably want to own a couple of these miners.
So even just what you're describing there, ordinal, how many Wall Street analysts do you think are getting in the weeds on something like ordinals? I mean, it's just, it's one of the original selling points that attracted me to this industry is that there is so much opportunity for edge. Like if you look at something like Amazon, you've got 50 analysts that have been covering that. Most of them have been covering it for 10 years. What could you possibly hope to eke out there in terms of real informational advantage? Whereas something like Bitcoin, people outside of the space don't know that there's an entire renaissance going on in Bitcoin block space. Transaction fees have reversed 4-year trend, 5-year trend, and are exploding upwards. Like, this is going to be super profitable for miners, and it's being driven by NFTs. I mean, it's so cool, but it's also, there's so much opportunity for edge and advantage there. So I completely agree with you. One other point I'd be curious to get your guys' take on, because I feel like this is another for sort of public market proxies for crypto. I think there's an enormous demand, especially during bull markets, to get exposure to crypto without owning any of the underlying. So you kind of see this hidden premium in miners, Coinbase, MicroStrategy. It used to be, I'm blanking on the name of the bank, but like some of the bank. Yeah, Silvergate. Yeah, Silvergate. This used to be the case. Voyager, Galaxy, etc. So I feel like that's, we're starting to see that a little bit again, but I feel like we're still not even there yet, but something to be aware of.
I think it'll be interesting to see, does the street continue to use MicroStrategy as that kind of purest, way to get exposure in the public markets to Bitcoin as opposed to the ETF? And Saylor went on, I believe, CNBC yesterday. He actually had a pretty compelling pitch, which is, basically MicroStrategy is a levered Bitcoin ETF with no fees, right? And when you look at, people keep talking about he's, diluting shareholders, because whenever MicroStrategy trades at a premium to the underlying, he issues shares, buys Bitcoin, and that's diluting shareholders. But in Bitcoin terms, it's not. If you look at the number of Bitcoin per share, that's been going up only since inception. So I think in a lot of ways, MicroStrategy is a really interesting way to get exposure, even with the ETF still alive. And I think it'll be interesting to see, does that kind of premium persist after the ETF? Because I think that you can make an argument that that's there because there's no other really pure way to get exposure. But I would guess Saylor is going to continue issuing equity as much as he can to keep stacking Bitcoin. And then, if you really, really zoom it out, like 20 years from now, you think Bitcoin is going to, whatever, nominal fiat price you think it's going to, you can make an argument that MicroStrategy might be one of the most, valuable companies on the planet. So I think that's one of the most interesting ones to me as well.
Yeah. A lot of people don't like Michael Saylor. And I'm not going to comment on, I get he has a bombastic style. He definitely has a lot of energy, which you can either appreciate or not. I think the trade that he made with MicroStrategy is going to go down as one of the best of all time. It looked like it might blow up on him with his, because he's issuing debt as well to buy Bitcoin. But it looks like he made it through the worst of that. If we go into a Bitcoin bull market, he's going to end up doing phenomenally. And I would
shout out to Sam Martin from the Blockworks Research team. We did a piece on this at the end of last year. Everybody was saying that MicroStrategy was going to get liquidated, but obviously wasn't the case. They actually ended up buying back I believe they bought back more Bitcoin or got back more Bitcoin through the Silvergate loan whenever they were unwinding. So he actually that was the only thing he could have technically got liquidated on in a traditional sense. He actually came out on the other end of that with more Bitcoin than he started with.
Yeah. I think I'm just looking at Bitcoin treasuries, and I'm not 100% sure if I think the cost basis is like 5 billion. The value of the Bitcoin now is 5.2 billion. The value is about 7.7. I mean, you can run those numbers on whatever your expectations are for where Bitcoin goes from here. But that man could be sitting on a lot of Bitcoin pretty soon, which is just pretty interesting. Yeah, good for him if it works out. Guys, unfortunately, we got to wrap up here. But, Reflexivity Research, I can't plug it enough. I think you heard on this call in between Felix and Will a very unique value proposition in terms of understanding and distilling the macro down into sort of actually very actionable advice on the crypto side. So really unrivaled offering. Highly recommend you go check them out. Guys, what's the best way that folks could either follow you or find out more info about Reflexivity?
Sure. You can check out Reflexivity at reflexivityresearch.com. Appreciate the kind words. Blockworks Research is awesome as well. I talk to those guys all the time. I always try to bounce ideas off them because they're a brilliant group of guys. We put out a ton of free content. We have a free newsletter, and then also behind paywall, we put out some content and have a bi-weekly analyst call that we do. You can find me on Twitter at WClementeIII. I'll pass off to Felix. Felix also has his own macro newsletter, which kind of combines macro and kind of degen crypto stuff, which I think is a really interesting overlay. You should check that out as well.
Yeah, thanks. Well, we'll definitely pass on the links, but you can follow me on Twitter, Fujo_Inc. Just to first bit of my first name, first bit of my last name, _Inc. Or on my newsletter that Will mentioned, dgenmacro.substack.com. But yeah, I want to give a shout out to Blockworks too. I think you guys are also really killing it at this intersection of macro and crypto, and it's my favorite podcast to listen to because those are my two worlds that I live really deeply in and I'm really passionate about. And there's not a lot of people that are doing it, so it's really cool to be able to go on a podcast and talk about macro and those parts, and then also jump into the degen meme coin stuff. So yeah, thanks again.
Yeah, you bet, guys. I appreciate the kind words as well. We'll have to do it again soon.
Awesome.
Absolutely. Thanks.
Cheers.